Greetings, class. This is our Chapter 8 video, at least the Part 2 video, that the material we covered in the WebEx session this morning. Now, I was going to post just the WebEx video online for you, but after looking at it, I decided to provide you with a video that was not obstructed or any way blocked where you couldn't see the content. So rather than just posting the WebEx as it happened, I am going to re-record the material that we covered today in this Chapter 8 video. And this will be to discuss really the budgets we talked about in our session earlier today, in our WebEx session, and really go through some of the material that's in the Excel spreadsheet as well. So this video can be replayed, and again, you can look at it without worrying about not being able to see some of the content. I'm not sure what was going on with WebEx, but we'll get a handle on it as we go through the rest of the semester. Right now, I want to talk about direct materials budget. And what we're doing now, this builds on the production budget or from the production budget. So we start with production and we go on to raw materials or direct materials. In this case, we're looking at an example of a direct materials budget where at this company, 5 pounds of material are required for 1 unit of product. And management wants materials on hand at the end of each month to be equal to 10% of the following month's production. So we have those two things. And then also they tell us that on March 31st, 13,000 pounds of material were on hand, and that material cost is 40 cents per pound. Now, going through the direct materials budget, we begin with the production budget, where we identified the number of units we wanted to make. We then identify the number of pounds of raw material for each of those units. So we have each unit requires 5 pounds of material. So in April, we take 5 times 26,000. We get 130,000 pounds of material as production needs for April. Now we need to add in what we want to have in desired ending inventory, which is 10% of the next month's production needs. In order to get that, we do this calculation here where we take 230,000 and take 10% of that, and we get 23,000 here, and we add that to the production needs in April. With that total of 153,000, we then back out the beginning inventory, which was given to us in the problem, 13,000. So now we have materials to be purchased of 140,000 pounds of raw material. When we do May, we work the same type of arrangement or calculation. So we take 5 times that production units, those production units to get the pounds of 230,000, and then 10% of the June production needs. And so we add those in and then deduct out the beginning inventory to arrive at the ending pounds of inventory that we need to have in May that we need to purchase. Again, we move forward to June, and here we take the 14.5 and bring it down as beginning inventory for June. This 11.5 they don't show, but that will be calculated based on the production needs for July. We'll take 10% of that again, and in June we'll have a desired ending inventory of 11,500, arriving at 142,000 pounds here. Now for the quarter, the ending inventory will be whatever it was in June, and the beginning inventory will come from the beginning of April. When we want to calculate what our expected cash disbursements are, which is a schedule of cash disbursements, much like the schedule of cash receipts, we'll go to this calculation where we look at our 40 cents per pound for materials and the assumption that one half of a month's purchases is paid for in the month of purchase and the other half is paid in the following month. So March 31st, the accounts payable balance is $12,000. So we begin with that. And then in April, we calculate the cost of purchases. 140,000 pounds times 40 cents, we get $56,000. But remember, half of it will be paid for in April and half in May. So we do that for the other months as well. So you can see in May we had 88,600. We calculate the split there. In June, we had a total purchases of 56.8, but we only take half of that for this quarter calculation. And then after we total those up, we get $185,000 is what we expect to spend for materials. Now we look at the direct labor budget, and here we identify that each unit of product requires 0.05 of an hour or 3 minutes of direct labor. The labor is unskilled because the production process is simple and formal training is not required. So this budget, and I'm not going to focus or major on it, but this is going to be a very straightforward calculation. We begin with the production budget numbers for the quarter, and then identify the direct labor time per unit here to show calculated labor hours that are required. We then multiply that times the labor rate that we're going to pay and get our direct labor costs. And that's it. That's the direct labor budget. Now, I'm not going to spend much time on this because we're not going to focus on it, other than to say these direct labor hours required will go into our next budget, which is a manufacturing overhead budget. In this case, in overhead, we're going to start with the direct labor hours here, and then we're going to calculate the variable manufacturing overhead based on the overhead rate, or the variable overhead rate. So here we say, okay, variable manufacturing overhead rate will be $20 per hour, and we're going to multiply that times the budgeted direct labor hours, and we arrive at a variable manufacturing overhead cost in April of $26,000, $46,000 for May, and $29,000 for June. Now, in this scenario, they told us that we have $50,000 per month of fixed overhead, and $20,000 of that is primarily depreciation, but it's non-cash. So we're going to add the $50,000 in to get total overhead. And here you see that happen. We add $50,000 all the way across. We get total overhead in the quarter of $251,000. So we're going to use that and divide it by the total labor hours required to get a predetermined overhead rate of $49.70 per hour. We come down here, the next step in this manufacturing overhead budget, because this budget is for us to decide how much we're going to spend, or how much we're going to use in cash and cash disbursements for overhead. So we deduct the non-cash portion to get the cash portion of overhead. And you see here that the $20,000 per month is taken out, and that means we have $191,000 for the quarter, and then that's different, of course, based on each of these months. But we are deducting the non-cash expense because we're interested to know what kind of cash disbursements we're going to have for those for that overhead cost. Now, this is a very brief budget that I'm going to show you. It's the finished goods inventory budget, and it's going to be based on what we know about direct materials cost per unit, direct labor per unit per hour, and then we are going to factor in manufacturing overhead based on the overhead rate we calculated a moment ago. When we do all of that, we get a per unit cost of $4.99. And so we take the ending inventory we calculated from the production budget right here of $5,000 times that $4.99 to identify the cost of ending finished goods inventory. Okay, this says prepare selling and admin budget. We're not going to do that. It's just know that it's there, but we're not going to focus on that. Instead, I want to focus on the cash budget because I think that's a very important budget. It's one that I used quite a bit when I worked at the Community Development Corporation because we were looking all the time at where our cash funds were going to come from. And so this is a very important budget to think about. So we have basically what we need to think about are cash receipts, what we're going to collect, that schedule of cash receipts, cash disbursements, a schedule that we're going to basically pay out for what cash we're going to pay out. And then we have, we're going to calculate a cash excess or surplus or deficiency and identify whether we need to borrow money. And then in the financing section, we're going to show what we do to cover the minimum balance we need to have. So here's some of the additional information they give us about this example. We need a minimum cash balance of $30,000. We borrow on the first day of the month and repay on the last. We had a cash dividend in April. We made purchases in May and June. And then we have an April 1st cash balance of $40,000. So those are the things we need to consider. So as we prepare this cash budget, I want you to see a couple of important things. First, we start with the cash balance, add in our cash collections, and get a cash available. Then we identify the cash disbursements that we're going to spend, what we're going to lay out. And this is going to be based on these other schedules that we've completed. The schedule of expected cash disbursements for materials, the direct labor budget, manufacturing overhead budget, and then selling and admin budget. Now those are all going to play into this. Those are the expenses that we have. Then we have the dividend. And when we get done, our cash disbursements are higher than our cash receipts. So now we've got a deficit of $18,000 that we need to cover. So we're going to go into borrowing, and we're going to consider when we borrow not just what we have the need of, that we have this deficit to cover, but we are also going to say we need to have a minimum operating level of $30,000 cash. So we'll borrow $48,000 to cover the $18,000 deficit and the balance of cash that we need to have on hand. In May, we go through that period through the month of May, and we see we collect more cash than we had cash disbursements, but we still didn't have enough of a surplus to pay back the amount that we borrowed. So we're going to wait until June for that. When we get to June, you'll see that things have changed quite a bit. We do have a surplus here that is large enough to take care of the credit that we extend, the financing we utilized. So we pay the balance of $48,000 plus the calculated interest. And the interest is calculated by taking the principal borrowed of $48,000 times the interest rate times the length of time we had this. Since we borrowed on the first and paid back on the end of the month, we had this a total of 3 months, and that means we have $1,920 in interest that we incorporate here in this budget. When we get to the end of the quarter, we include all these financing transactions independently in that column so we can identify what we really do have in ending cash for the entire quarter. Okay, that's it for the PowerPoint. That's all I wanted you to see there. What I'm going to do now, in our handout, we had the problems, the demonstration problems part 2. And so I'm going to go through these 3 problems that are on that handout. And by the way, I have uploaded this blank Excel spreadsheet in Canvas, so you can utilize it if you want. So at this point, I want to go through these 3 problems and show you how we calculate them. So the first one is this Mini Products. They're making clocks, a small digital clock. Each clock is going to take 5 batteries. The batteries are made overseas. We want to make sure we don't run into a supply chain problem. So we're going to have a larger than usual inventory need before we start into the next month's production. In other words, we're going to require a level of inventory. It's 25% of the following month's production needs before we get to that following our quarter, not month, following quarter's production. So each clock takes 5 batteries. It costs $6 each. We need to have an ending inventory that's equal to 25% of the following quarter production needs. And we have a total of 50,000 batteries on hand to start the first quarter of year 3. So what we're going to do to start with is identify that for each of these products that we were identifying, this required production of clocks, we're going to need 5 batteries for each one. We're going to do a multiplication here, 5 times the 40,000 clocks, to find out how many batteries we need. So in the first quarter, we're going to need 200,000 batteries. In the second quarter, we're going to need 225,000 batteries. In the third quarter, we need 275,000 batteries. And in the fourth quarter, we need 300,000 batteries. Now, overall for the year, we're going to utilize 1 million batteries. Now, the reason we have the first quarter of year 4 here is because we need this in order to calculate the desired inventory, ending inventory for the fourth quarter. So we're going to calculate that here. 5 times the 44,000 units, we get 220,000. Okay, our next step then is to calculate ending desired inventory for each quarter. This means taking 225,000 times 0.25, and that gives us 56,250 as a desired ending inventory of batteries for the first quarter. We add those two together. We get 256,250. We deduct the 50,000 batteries we had to start with. That gives us a total battery need of 206,250. But we need to multiply that by $6 because that's the cost of each battery. And so we get a total cost here of 1,237,500. We apply the same steps to the second quarter, and that means that we have a desired ending inventory in the second quarter of 68,750. We have total battery needs of 293,750. We have a beginning inventory of 56,250. And that comes from right here. This is the ending inventory or desired ending inventory from the first quarter. So we take this and we subtract out the beginning inventory to get the amount of purchases we need or how many batteries we need to buy. And that will be a cost of 1,425,000. Okay, we do the same thing for the third quarter. and we get 75,000 as a desired ending inventory. We're going to add these two together. We get 350,000 as a total needs, but then we subtract out the 68,750 here. That's the beginning inventory, and that gives us the total required purchases in the third quarter of 250, and that means we have $1,687,500 as the cost of those purchases. We get to the fourth quarter, we're going to do the first quarter of year 4 times 0.25 to give us the desired ending inventory of 55,000 units. We add those to the 300,000 we already have. We have 355, and then we subtract out the 75,000 that was the beginning inventory for the fourth quarter, the ending inventory for the third quarter. So we wind up with a need to purchase 280,000 batteries. So we take the $6 times 280,000 and we get 1,680,000. Now if we're looking at the year-to-date column and we come over here to the year end, we're only going to look at the desired ending inventory for the fourth quarter because that is at a point in time. We're not going to sum any of that up. We're just going to take the last number as the ending inventory. We'll add those together, the 55,000 plus the 1 million production needs in batteries. And then we're going to subtract out the beginning inventory, which is way over here in April, or it'll be the first quarter, not April. First quarter, so we subtract, or we have 50,000 as the beginning inventory, and we're going to subtract that. So we take the 1,055,000 minus the 50,000, we get 1,005,000. Our total cost per battery is still $6, so we take that times the 1,005,000 to get $6,030,000 for the cost of these batteries for the year. That's the entire year. Okay, that's part one. That's the direct materials budget for the batteries. The next one we're going to look at is an overhead budget, and in this case we have a company, Island Company, who has budgeted direct labor hours for each of the 4 quarters, and then they have a variable overhead rate of $2.30. So we're going to put the variable overhead rate in here for all quarters and for the year to date. And then we're going to multiply those to get the variable manufacturing overhead. Okay, so variable manufacturing overhead is 23,000 for quarter 1. For quarter 2, it's 25,300. For quarter 3, it's 26,450. And for quarter 4, it's going to be 24,725. For the year to date, it'll be 99,475. So we're going to take those numbers that we compute based on labor hours and add in the $60,000 per quarter of fixed overhead. So 60,000, 60,000, 60,000 in quarter 3, 60,000 in quarter 4, total of 240,000 for the year. So that's our total fixed manufacturing overhead. And we're going to add the fixed overhead and variable overhead together to get total manufacturing overhead of $83,000 for quarter one, $85,300 for quarter two, $86,450 for quarter three, and $84,725 for quarter four. Our year-to-date will equal $339,475. Now, the last part of this that we need to consider is the non-cash expense that's in this manufacturing overhead. We have $20,000 a month, according to what they tell us. Most of that's depreciation, so we're going to back that out. So we take the $20,000 per month, or per quarter, not per month, $20,000 per quarter for all 4 quarters. And then we have $80,000 in total for the year. So we take the total overhead cost minus the depreciation, which is non-cash expense. So in total, the overhead, cash disbursements for overhead will be $259,475. We're going to take the budgeted total manufacturing overhead of $339,475 and divide it by the budgeted direct labor hours of 43,250. We get a rate, a predetermined overhead rate of $7.85. Okay, that was an overhead budget. Finally, the last thing I want to do here with you is show you the calculation for a cash budget. Now, this is one that I said is very practical. We used it when I worked at the CDC. Anybody in a not-for-profit business understands that your sources of cash are not as evenly or as predictable as perhaps they are in a for-profit business. So these cash receipts are going to be important to calculate the cash flow. So we're going to start here with this problem for tree forms. They have total cash receipts over the 4 quarters and then total cash disbursements. They're going to have a minimum cash balance of $25,000, and the beginning cash balance for the year is $35,000, which is already in the worksheet. They may borrow any amount needed from the local bank, and the interest rate will be 5%. So we start with the cash receipts from quarter one, and if you look at the table that we have up above here, we see it's $650,000. We're going to add that with the cash at the beginning, and then we're going to subtract out cash disbursements of $850,000. However, here we have what is a problem because the cash flow in is less than the cash flow out. We're going to have some money. This is a deficit. We need to borrow at this point. So we look at this and we say we need $35,000 cash at the end. We have $165,000 deficit here. We add those two together and we get $190,000 that we need to borrow. So at this point, the financing section just has the $190,000 that we borrowed. But what we're going to do is we're going to calculate what that difference is between the $190,000 that we borrow and the deficit that we had, and it's a $25,000 balance, which lo and behold is exactly what our minimum cash balance is. So for quarter 2, we put this up here as the beginning cash balance for the quarter. We add the cash receipts, 700,000. Cash disbursements, well, I'm going to total those first. Cash disbursements of 485,000. And we subtract those out, we get $240,000 balance. Well, since we have enough cash right now, we can pay that financing charge back. So what we're going to do at the end of this quarter, we're going to pay back or subtract out the 190,000 principal, which is what we borrowed, and then we're going to calculate the rate, which is 5% times the principal of 190,000, and multiply that over the period of time, or factor it for the period of time we actually have it. So you're going to calculate 5% of the fund for each quarter. In this case, it's going to come out to 10% for the whole thing, because we have it for 2 quarters. It's going to be $19,000. So the interest rate here is based on a quarterly basis rather than a monthly basis. So they had 5% per quarter. There's 2 quarters. It's 10% interest, and that's what that interest. That's where that interest comes from. So then we calculate. We're going to add these two together, and our total is going to be 209,000. It's a negative cash flow because we're paying it back to the financing, but that gives us an overall positive cash flow of $31,000, and that's above the minimum that we need for the end of the quarter. Third quarter, we begin with 31,000. We add 490,000 in cash receipts. We have total 521, and we subtract out 460,000. That means we have $61,000 in cash at quarter 3. Since we don't have any transactions down here, we're just going to add that 61,000 plus the 0 that we have here, giving us 61,000. Quarter 4, we take the 61,000, we add in the 510,000 in cash receipts, add these together, and then we subtract out the 525,000 in cash disbursements. We arrive at $46,000 in cash. And again, because we're not going to have any transactions in the financing, that's $46,000 in cash right there. Now, this is just the 4th quarter, but when we look at the year, we're going to start with the beginning balance in cash of $35,000 over there. We're going to add up all of these cash collections that we show. And so when we add these up, we get $2,350,000. And then we have total cash disbursements of $2,320,000. Which means we have a total surplus of $65,000. However, we need to calculate or show the sources of financing right here and the uses of our funds for financing right there. So we have the positive 190,000, the payback, which is a negative 190,000, and the payment of interest, which is a negative 19,000. So that really does cover all of the budgets I want to talk about in Chapter 8. Again, my interest here is to cover the ones that I believe that you'll find most useful and helpful. The cash budget is certainly one of those. So if there are any questions, stay in touch. I'll post this video online. Again, my apologies for the problems with the WebEx, but I wanted to give you a clean video to work with. Take care. I'll see you next time.